Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable investors. Thanks for tuning in to another episode of Scalable Real Estate and Investing. I'm your host, Mason Clement, and we have John Bowens with us today, who is with Equity Trust Company. We're going to dive into self-directed IRAs and how you can use these vehicles for your real estate investing and other things in life. So without further ado, let's jump into things. John, what's going on? How are you doing?
Hey, Mason, I'm doing really well. Thank you for asking. Excited to be here and excited to share some of my experiences and some of the experiences of some of my clients with self-directed IRAs, solo 401ks, and other tax advantage investment accounts, all investing in real estate. That's a major focus of ours amongst many other types of alternative assets. So I'm eager to answer some of your viewers' questions, and I know you have a number of questions, I assume, lined up there as well.
Yeah, definitely. So what I like to do starting out is just talk about the guest's background and their journey to what brought them to today. So could you get into that and what brought you to Equity Trust and this side of investing?
Yeah, absolutely. I've been in real estate for 20 years, and I've been in self-directed IRAs for 15 of those 20 years. And my background, even prior to Equity Trust and self-directed IRAs and retirement plan services, was more in traditional finance. And when I was in business school, I was studying finance. And what I learned early on was IRAs, 401ks, and other retirement plans were synonymous with the stock market. And the only way to invest in IRA, 401k, or other retirement plan was to put it in stock market-based investments. That's what I was always told, and that's all I ever understood. And at the time, I was also working for a real estate company. And it was my best friend, his father and grandfather. They owned a lot of real estate, residential and commercial, mainly commercial. And so my upbringing was always around real estate. I always had a passion for that as a result of that. And I remember asking my best friend's father and grandfather, because I was learning about IRAs and 401ks and all of these different types of retirement plans. And to me, all of these types of retirement plans, it was really exciting because I learned that you could make investments, and in a Roth IRA environment, you would never pay taxes. In a traditional IRA or tax deferred environment, you would defer your taxes. So in my mind, I was thinking, wow, from a compounding interest perspective, these accounts are really, really powerful. So I went to my friend's father and grandfather, and I said, hey, why? I don't understand why you don't have IRAs, 401ks, and other retirement plans, because they had mentioned before that they don't really believe in IRAs and retirement plans. So I had to drill down a little bit further into that. So, why don't you believe in IRAs and 401ks and other retirement plans? I mean, these are super highly tax privileged accounts. There's a lot you can do with them. And they said, well, John, we don't believe in the stock market. we've made all of our money, all of our family's wealth in real estate and investing in small businesses. And so we have no interest in investing in the stock market. And that 15 years ago, I then came across Equity Trust Company, and I met our founder, Dick Desich, who's widely known as the pioneer of the self-directed IRA industry. Because the whole time I was thinking to myself, scratching my head, there's got to be a better way as far as being able to save for retirement, and not just being able to put your money in a traditional mutual fund type portfolio or other traditional asset type portfolio. And so I met Dick Desich, and he became my mentor. And he's widely known as the pioneer of the self-directed IRA industry. He put together one of the very first real estate transactions with IRA investors back in the early 80s, about 22 clients at that time. And now we have over 230,000 customers, and we custody and have under administration over $40 billion. And so I learned from Mr. Desich that, hey, you can buy rental property with an IRA account, and the cash flow that comes back in, you don't pay taxes, you sell the property, you don't pay any long-term capital gains tax. You can make private money loans. You can invest in startup businesses. You can invest in real estate syndications. You can invest in self-storage. You can be a private money lender. You can buy notes and mortgages. So I learned about all of these incredible ways in which I could use a retirement plan, an IRA or a 401k rollover or a TSP roller, how I could use these retirement accounts to invest in real estate. And it was at that point that my life really changed, because it made me approach, and it allowed me to approach investing in a completely different way, in a completely different way that I was taught. You know, I spent thousands of dollars academically to learn how to trade stocks and invest in the traditional markets. And nowhere along the way did anyone expose me to being able to use an IRA to invest in real estate. And so I've been self-directing my accounts for a number of years, and I've had the opportunity to teach over 60,000 investors across the country how to do the same, from flipping houses in an IRA to real estate joint ventures to rental properties, land investing, investing in self-storage syndications. I've had the opportunity to participate as a self-directed IRA custodian in a lot of these different transactions.
Okay, perfect. And then you said you're also a real estate investor. So how are you using your self-directed IRA or other vehicles to invest?
Our primary focus with our self-directed IRAs is private money lending. So lending money secured by real estate to other investors, primarily single family home flippers. And so we'll make anywhere between a 6-month to 12-month to 18-month term loan. And we have interest and principal flowing back into our self-directed IRAs. When I say us, I'm referring to my wife and I. And all that interest is tax-free in our accounts. More specifically, we, to our best ability, use our Roth IRAs and Roth accounts to invest, because those monies are after tax and they grow tax-free. So as we have profits flowing back into our Roths, we'll pay 0% tax on that profit. And eventually, after the age of 59 and a half, we'll pay 0% tax. So from a Roth perspective, we're hedging against potential increase in taxes from a government policy perspective, as well as from our own tax basis perspective. And so we do to our best ability, we try to invest as much with our Roth as we can. But we also have rental properties and have had rental properties. And we also invest outside of our IRA. So it's not singular focused. We're not just investing in real estate with our IRAs. We're also investing outside of our IRAs. And that's something I always let people know, that, self-directed IRAs are great savings vehicles. But a lot of the folks that I work with, they have real estate investments inside their self-directed IRAs, and then they have real estate investments outside of their self-directed IRAs. So you have to really think of it as a rising tide. It's not a one versus the other. But if you can find great real estate opportunities and you can do those in your self-directed IRA, you can put yourself in a position of being able to mitigate or eliminate your tax liability. And of course, most importantly, start growing a nice retirement nest egg. And unfortunately, a lot of Americans, they have little to no savings in a retirement plan. In fact, there was a Government Accountability Office study that was done that reported that 41% of Americans have $0 in retirement savings. 50% have little to no savings. the average 55 to 64-year-old only has about $104,000 saved in retirement accounts. So we are without a doubt in a crisis in America with respect to retirement savings. And it's interesting because I'll add one other fact in here, Mason, for anybody out there that's interested in the data in this area. There's a Government Accountability Office study that was done in 2016. And the IRS reported that there are 9,000 $5 million and up IRAs. Could you imagine having a $5 million IRA? Well, I've seen them before. And I'll tell you that most of the $5 million and up IRAs don't just have stock market based investments in there. They have unconventional alternative investments. In fact, in this report, the IRS examined these 9,000 $5 million and up IRAs, and they found that 25% of the reported value were in unconventional assets. Unconventional assets means real estate, private equity, hedge funds, private assets, not just stock market-based investments. And they went on to say, and I'm quoting this directly from this particular report. It's a Government Accountability Office report. It was in 2016. And they said that these unconventional assets, that in most cases, they would argue that the value of these accounts are because of these unconventional assets. I'm paraphrasing a little bit there, but that's essentially what they were saying. And so, I got to scratch my head a little bit there because you think about it, most Americans don't know that this concept even exists. Yet the wealthiest of the wealthiest IRA investors are doing what? Most of them, I can't say 100% of them, but most of them, based on this report, are investing in unconventional assets. They're investing in alternative assets. And so we have to look at, what is the wealthy doing? The wealthiest of wealthy, the top 1% of 1%. What are they doing that most of us don't have access to or aren't doing? And the truth of the matter is most people just don't know about this or haven't taken the time to educate them on it, which isn't necessarily a bad thing. Don't feel bad for yourself or beat yourself up over, having your money all in the stock market and maybe taking losses over time. Because the reality is just like me, I spent thousands of dollars academically, never learned about an IRA being able to invest in real estate. So, you're not alone if you're somebody out there thinking, well, gosh, I wish I would have done this years ago, or I wish I would have known about this years ago. Unfortunately, there's just not a lot of good information out there. And I appreciate you, Mason, for putting on podcasts like this, because this is how we get to spread the word about all of these incredible opportunities.
Yeah, definitely. I mean, that's the beauty about YouTube University and the podcast is you can really create your own curriculum and learn about things that they don't teach you in school. And I'm actually I don't know if you saw my LinkedIn profile, I'm a chartered financial analyst, and through all three levels, I don't remember if they even taught self-directed IRAs in that content either. But yeah, and even that's like, one step beyond just getting like a bachelor's degree in finance, which I also got. And I can agree with you, they didn't teach me either at UT Austin, the self-directed IRA strategies and all that. So glad we're having this conversation to enlighten folks. So out of those, I was curious, the 40 billion or so you'll have in custody, how much is still sitting in cash, not deployed, even though it's in a self-directed IRA?
Yeah, that's a great question. Somewhat of a proprietary question. I'm not at liberty to give specific details in terms of how much cash is in accounts. What I can tell you, Mason, is that at any one given time, there are folks that have IRAs and retirement plans, and they are in a cash position because maybe they sold a property in their IRA, or maybe they made a private money loan and the cash comes back in their IRA, and then they're getting ready for their next investment. They're on dry powder and they're waiting for that next opportunity to present itself. Most of the folks that I work with, Mason, they have an idea of what they want to invest in. So they have that investment in mind, and they open their account and they transfer or roll over their funds from their existing IRA or 401k into a self-directed IRA in preparation for that investment. As far as how much cash is sitting in IRAs, I'll tell you there are $9 trillion in IRAs. And then if you start adding in like 401ks and profit sharings and pensions, you're at over $20 trillion. But IRAs alone, you're looking at $9 trillion. So if you did some back of the cocktail napkin math, you probably find, especially with what's going on in today's financial markets, that there's probably a lot of cash sitting out there. So for anybody out there that, is maybe raising capital or looking for partnership opportunities, don't be surprised if you come across an investor that has an IRA and is in cash and looking for a place to invest that cash. And at that point, you can inform and educate them on a self-directed IRA, maybe even refer them to a podcast like this so that they can learn about who are the custodians out there. Equity Trust would be one custodian that they can reach out to, and we can help them understand how they can use their self-directed IRA funds to invest in non-standard investments, non-stock market investments. And I should mention, Mason, we don't give tax, legal, or financial advice. We don't sell investment products. So when someone comes to us, they have the peace of mind knowing that, we're not going to persuade them into investing in something that might not be a good fit for them. They get to make all the decisions. They're in the driver's seat. That's what a self-directed IRA is. It's an industry term. It indicates to the investor that they have the ability to self-direct, whereas most financial institutions aren't going to let people buy real estate, make loans, invest in real estate syndications. It's just not part of their core competency.
Yeah, and you already hit on it a minute ago, but just maybe a few weeks ago, I spoke with some of my college alumni friends who were interested in investing with me in some real estate deals, and they were also just completely unaware of the simplicity of it. It's just like any other custodian. You just have to find the right custodian, like Equity Trust, that's able to facilitate the self-directed IRAs. It's not like you have to jump through a bunch of magical hoops or climb a giant beanstalk to get to this castle in the clouds. It's just
right,
simple stuff. It's rolling over from one custodian to the other. So can you maybe just back up a little bit though? Can you just discuss some of the differences between like a self-directed IRA and like a solo 401k? Because both of those are like self-directed, but they're different names. So can we just get into like all the different self-directed vehicles and how they differ and all that stuff?
Yeah, absolutely. There are really 7 different types of self-directed accounts, 7 different types of, let's just say, retirement accounts. And these could be self-directed, or maybe they're not self-directed. So the 7 accounts are as follows: the traditional IRA, the Roth IRA. Those are the 2 most common. And then you have 3 business retirement accounts: the SEP IRA, the simple IRA, and then the solo 401k. And then the last 2 accounts aren't necessarily retirement accounts, but they are and can be self-directed, is the health savings account and then the Coverdell education savings account. So those are the 7 accounts that we talk about commonly. As far as retirement plans are concerned, you also have in there 401ks, thrift savings plans, 403bs, profit sharing plans, defined benefit plans. Now, when you go and work for a company and you have a 401k, or maybe you're like a teacher or work for a hospital and you get a 403b instead of a 401k, or maybe you're a federal government employee and you get a TSP, thrift savings plan, not a 401k, or you're a firefighter, police officer, and you get what's called a deferred compensation. It's a 457. It's like a 401k. So there's all these different terms out there that, quite frankly, it's very confusing to the American public. It's something that I would love to change at some point in the future, is to just make things simple for people. Why do we have to call a TSP a TSP? Let's just call everything a 401k. Make it easy. But this isn't political talk radio. I think this is financial talk radio, so I'll stick to that topic, Mason. But the point is that these different types of employer plans, you, in most cases, cannot self-direct into real estate. They're not going to let you. You can only invest in mutual funds. So what you have to do is you have to roll that money over into a self-directed IRA, and then you can deploy that capital to buy a property, rent it out, rental income comes in, make a private money loan, invest in self-storage, real estate apartment building, whatever it is that you're doing. But the existing plan most likely is not going to allow you to do that. Now, at this point, I usually have people ask me, well, can I move my money while I'm still working? Most likely, you're not going to be able to do that. There are some exceptions to that rule. It's called an in-service withdrawal. That's what you would want to ask for. When you're 59 and a half or older and you're still working, chances are good that you can do one of these in-service withdrawals, which means you just roll the money over to an IRA while you're still working. Otherwise, if you don't qualify, you're going to have to leave that employer. They force you out, or you retire, and then you can roll your money over into a self-directed IRA. Now, can you go to a traditional financial institution, Fidelity, Schwab, Vanguard, TD Ameritrade, you name it? Most of these companies do offer a self-directed IRA. You can open up an IRA. The problem is you're only going to be able to self-direct into stocks, mutual funds, ETFs, bond funds, options. The closest you're going to get to real estate is maybe a publicly traded real estate investment trust. But most of the folks that I work with, they're not interested in a publicly traded REIT. They want to own property. They want to buy land. They want to invest in self-storage partnerships. They want to get to the Main Street real estate investment. A lot of the folks that I've worked with, they want to migrate away from Wall Street and move into Main Street. And if you want to do that, you have to go through this transition of moving to a new financial institution. So equity trust, that's what we do. That's what we specialize in as a custodian, is the custody of these IRAs that allow an account owner to truly self-direct those accounts into real estate and not be limited by just the traditional stocks, bonds, and mutual funds.
Okay. Yeah, just actually as a side question, you actually had answered another question I had, like traditional versus Roth IRAs, but I'm curious now, is it possible to convert a solo 401k to a Roth IRA? Because I know you can convert a traditional IRA, but could you convert other vehicles to Roth IRA?
You can, and let me make sure I answer the question on the difference between a self-directed IRA and a solo 401k. So a self-directed IRA, almost anybody in America can have a self-directed IRA. You then have a solo 401k. Now, the contrast between the two, a traditional IRA or self-directed IRA, you put money in as a contribution if you're eligible, and there are certain contribution limits that you have to abide by. But most of America qualifies for an IRA. You just have to have earned income, essentially. So that is income that you're paying Medicare, Social Security tax on, and your ordinary income taxes. So most of America can open up an IRA. It's easy to do. It's just an account. It's like opening up a bank account. The solo 401k is for self-employed business owners. Now, you might be a sole proprietor. So maybe you're John Bowens doing business as John Bowens. For example, if I'm a real estate agent and I'm selling real estate, I get commission. I get what's called a 1099. And I have some expenses, and then I have an amount that I have to claim as self-employment income. And I pay taxes on that, not just federal, state, local tax, but I'm also going to be paying my payroll tax, my Medicare and Social Security. So that's the price to pay to get in the game. If I'm a self-employed individual, I can look at opening up a solo 401k. If maybe I have an LLC, S Corp corporation, I don't have any employees, I have W-2 income that I'm paying myself, I can open up a solo 401k. And you'll notice that I'm being very deliberate in mentioning self-employed and having earned income. Passive income. So I have a lot of people that say, John, I want to open up a solo 401k. And I say, okay, well, did your CPA advise you to open a solo 401k? Well, no, I went to this seminar last weekend and there were these people selling $50,000 packages and they said I need to open up a self-directed solo 401k. That's probably not a legitimate source. All right. I'm not disparaging those folks out there that have those types of education companies. I'm just saying be wary of it because there's a lot of bad information out there. In fact, I have a lot of people that come to my seminars and conferences and they learn that they opened these solo 401ks and they were never even eligible. And then they come to me and they say, John, can you help me unwind this? Well, no, I'm not a CPA or a tax attorney. You're going to have to go talk to one of them now. So you got to be very careful about this. And so you have to have earned income in order to even open up one of these solo 401ks. And not everybody does as a real estate business owner because some people have enough deductions. Maybe all they have is rental income. It's all passive income. So they don't even qualify for a solo 401k. But why would someone want a solo 401k over an IRA? Well, there are some attractive features to the solo 401k when investing in real estate. The first one is your contributions can be significantly higher than an IRA contribution. So IRAs in 2023, you can only contribute up to $6,500 when you're under the age of 50, $7,500 when you're 50 and over. But in contrast to a solo 401k, as an employee, you can contribute up to $22,500 when you're under the age of 50, and then $30,000 when you're 50 and over. And then there's what's called an employer deferral, which is like a match. And your combined amount between your employee contribution and your employer deferral can actually be upwards of $66,000 when you're under 50, up to $73,500 when you're 50 and over. And oh, by the way, Mason, you can actually get that all into an after-tax Roth bucket. So could you imagine that? Could you imagine if you paid yourself enough, and let's say you were 50 or older, you could get $73,500 in as a contribution into the Roth bucket of your solo 401k. So these things have a lot of horsepower on them, but you got to qualify for them. The other last point to mention on the solo is that you can't have any employees with the exception of your spouse. So if you have, let's say, a property management company and you have 3 people on payroll and you were thinking, I'll open up a solo 401k and just not worry about those employees, you're not going to be able to do that. You're not going to qualify for the solo 401k. And then the other benefit, Mason, to the solo 401k for people that are investing in real estate is when you invest in real estate and you use leverage, in an IRA, you can be subject to a little known tax called unrelated business income tax. Also, in the context of debt finance real estate, it's known as unrelated debt financed income tax. But the beauty of the solo 401k is, so as long as the financing is structured properly, and in most cases it is, you can be exempt from that unrelated debt financed income tax under the auspices of the solo 401k. So I see a lot of investors that prefer the solo 401k if they're eligible, if they want to leverage up and do more real estate rentals with leverage, or if they're investing in like a self-storage syndication or multifamily apartment building syndication with their retirement funds, they may want to use their solo 401k so they can avoid the unrelated debt financed income tax.
Interesting. Yeah, I think I had heard about that years ago and forgot about it. So that's good. So I probably just need to speak with my custodian about converting the existing solo 401k I have to like the Roth buckets.
Oh, you did ask that question, Mason. So if you have a solo 401k or a 401k, and let's say your money was tax deferred, and you said, you know what, the crop right now is like 3 feet high and 10 rows wide, and I think that I'm going to grow this account to 20 feet high and 60 rows wide, and I'd rather pay taxes on the smaller crop before it gets really, really big. You can actually convert. It's called a Roth conversion. You just convert your tax deferred money into your Roth account, pay your taxes now. It grows tax free for the rest of your life. You take it out, you don't pay any taxes. And a great example of that, Mason, we were talking about case studies before you hit the record button. I have 2 clients out of St. Louis, Missouri. Their names are Kevin and Cynthia. And in 2010, they opened up self-directed traditional IRAs, because they had 401k money from their old jobs, and they rolled those 401ks over into traditional IRAs. No taxes or penalties to do that movement. You're just doing a rollover from 401k to traditional IRA. So that was the first stop for them. And Kevin and Cynthia, their story was that they referred to themselves as stock market refugees. They no longer wanted to invest in the stock market. They wanted to invest in real estate. And so they rolled their money over, and then they converted their $200,000 into Roth IRAs, and they paid taxes. And at about a 35% tax rate, they paid about $70,000 in taxes in order to get that $200,000 in their Roth. But guess what? They've grown those accounts now to over $1 million in properties and cash flow. They have $130,000 in tax-free cash flow coming in every year from their 14 income-producing properties and notes that they have in their self-directed Roth IRAs. They buy houses, fix them up, rent them out. They buy, sell on a lease option to purchase, and they also buy and sell on owner financing. They've done over 20 real estate transactions over the last 12, 13 years, and they've grown their accounts in a very substantial way. And that 130,000 that comes in every single year, they pay 0% tax on. If they sell properties in there, there's no long-term capital gains tax. There's no worry about recapture depreciation. They don't have to worry about a 1031 exchange. They don't have to worry about Schedule E's. It's all tax-free going in their Roth IRA because the way they have it structured. And when I asked Kevin and Cynthia, what are you planning on doing with that money in your retirement years? Because they're over 59 and a half now. They said, John, we don't plan on using any of this money ourselves. We want to leave this to our children, or if our children have children, we want to leave it to our grandchildren because they'll inherit the Roth IRAs 100% tax-free and they'll never pay taxes again. So what you'll find, Mason, is that these Roth IRAs can be highly powerful tax savings vehicles because we're leveraging compounding interest in the absence of taxation, which can help us get to our retirement goals and financial goals in a shorter period of time. But it also helps us with our legacy in our estate. And a lot of people you'll find will use their Roth IRAs for those purposes as well.
Okay. Wow. Yeah, that's really inspirational story. It sounds excellent. So even after you say they did want to use that money when they're in their retirement, as you take withdrawals from the Roth IRA, you're still not paying taxes on it because you already pay taxes up front. Is that correct?
That's right. You got it, Mason. You pay taxes on the seed or on the crop. So with a Roth IRA, the money goes in after tax, whether you're getting it in there through a contribution or converting from a traditional or 401k type account. And then it grows tax-free. And after the age of 59 and a half, when you start pulling money out for personal use, if you decide to do that, you pay 0% tax.
Okay, cool. So I want to understand the flip side of the coin. What are some pitfalls of using a self-directed IRA? Because I heard once, for example, you can't put in sweat equity into a rental property that you buy with your self-directed IRAs. Is that true?
That is correct. So 4975 of the Internal Revenue Code tells us that we're a disqualified person. As an account owner, we're a disqualified person to our IRA. Our spouse is a disqualified person. Our children, our grandchildren, our parents, our grandparents, anyone up and down the family tree, and any businesses that we own and operate for all intents and purposes. So our real estate LLCs and our trusts and our other entities, those are disqualified persons. And the tax code 4975, it's actually C1C, says the furnishing of goods, services, and facilities. So I, as an account owner, cannot provide services to my IRA. Now, what are services? Well, could be broadly interpreted, but many would argue that if I go to my rental property that I own in my IRA and I start swinging the hammer to the nail, that's sweat equity, that's services, therefore a prohibited transaction. So I need to stay away from that. The rule of thumb that we use in the industry, Mason, is stick to the desk duties, stay away from the sweat equity. Here's my litmus test, because I've owned rental properties in my self-directed accounts, and here's my litmus test. When I show up to the property, I pull in the driveway, I go out, I talk to the tenant, I make sure things are in good working order, I do some inspection, right? I make sure things are taken care of. I meet with contractors there, right? Possibly inspectors, right? There's all kinds of desk duty that I need to do. The moment I drop my tailgate and start pulling tools out of the back of my truck, that's when I know I'm in trouble. So that's what I stay away from, because I want to make sure I stick to the desk duties and not start encroaching in that sweat equity and therefore being viewed as providing a service. Now, some investors, they, especially once they start to get to multiple properties in their IRAs, they prefer to hire a property management company. So if you're someone that is very concerned with encroaching on these sweat equity services rules, you may just want to hire a property management company. And the important thing to understand about the economics or financials of this, and coming from your academic background, Mason, which I appreciate as a CFA, you probably are already thinking about this in your mind is, if I calculate the tax savings, well, with all those tax savings, I should be able to more than justify paying people to do the work for me. And a lot of my clients that I work with, when they run the numbers long-term, they find, there's no reason for me to try to put myself at risk. With the tax-free savings, I'm going to make up for that and then some, and when I'm paying people to do the work for me. And of course, when you're paying other people to do the work for you, you're in a position to be able to go out and have more time to find the next opportunity and focus on what we should be focusing on as entrepreneurs and business owners and investors, and looking for the next big opportunity to take down.
Okay. Yeah, that leads me to my next question. Say it's not this simple example of a rent house, but like a self-storage facility. I guess, would it be okay if well, it's actually something I'm considering. So I have, say, 50,000 in my solo 401k and then 50,000 of my own after-tax dollars, and I want to put that $100,000 of equity on the loan as a down payment. And then, so like we're partnering, basically I'm partnering with myself and then this other entity, kind of a reflection of myself. And how much management can I do myself at that point, that before it becomes a prohibited transaction?
Yeah. So you can, in fact, partner your IRA money with your non-IRA money. So in that example, let's say you were going to do a $100,000 down payment on $1 million property, and you put in 50 with your IRA or solo 401k, and then personally you put in 50. So that's going to be a 50-50 partnership. So you're going to have a tenants in common ownership, or maybe it's an LLC type structure, but it's going to be 50-50 owned, your IRA and you personally. Now, you do have to be careful. If you're going to partner with yourself like that, you have to make sure that all of the profits and all the expenses flow 50-50. You cannot deviate from that percentage, because if you disproportionately allocate profits or expenses, it's going to be a prohibited transaction because you're a disqualified person to your IRA plan or solo 401k. So you can partner, but you got to be careful on how you do that. Now, if you borrow money, you can borrow money, meaning your IRA takes on debt, or your IRA is taking on debt through an LLC type structure. But the debt cannot be debt that you as an account owner are signing a personal guarantee on. You're going to hear the industry use the term non-recourse loan. That is what it is, but I don't really like to even use that term. Your IRA can only borrow money, and your IRA can only be involved in transactions where you are not signing a personal guarantee. So if you're the GP, the general partner on a deal, and the bank or the lender is going to make you sign a personal guarantee and your IRA is involved, you just created a prohibited transaction. You just invalidated your IRA, and your entire IRA becomes distributed January 1 in the year in which you took on that loan. So can you put together a deal like that, Mason? You could. You just got to make sure it's structured the right way and the financing is structured the right way. Now, back to the partnering. I'm glad you brought that up, Mason, because partnering IRA money with other investors can be highly impactful. So I mentioned partnering your IRA with your non-IRA money. I'll give you an example of a property that a customer that I worked with years ago, he bought a house in Carmel, Indiana for $75,000, and he partnered his Roth IRA at 82% and then his wife's Roth IRA at 18%. 3 years later, after renting it out for 3 years, he sold it for $210,000. Over the course of 3 years, the sale and the rental income flowing back in, he had roughly $150,000 in profit. And so all of the income and all the expenses just flowed 82% for his Roth IRA and then 18% for his wife's Roth IRA. So you can partner with spouses, you could partner with your non-IRA funds, just got to make sure that's done proportionally. Now, what if you partnered with what's called non-disqualified person? So think an investor friend that you meet at a real estate investor meetup group, or on a podcast, or wherever, right? Maybe online through one of these different online sites where people meet each other. That is real estate oriented, of course, right? So, let's say I meet another investor. Well, they're not related to me. I don't necessarily need to negotiate a proportionate split. Let me give you an example. I have two clients here at Equity Trust, Doug and Ron, and they met each other at a real estate seminar, and they're just investor buddies. They're not related to one another. And Doug, his problem was he only had about 13,000 and some change in his Roth IRA, but he had the ability to find real estate opportunities, negotiate them, buy them, fix them up using his contractors, doing all the desk work, of course, and then selling the properties and making a profit. And this is in Dayton, Ohio. So about 9 months ago, he came to me, he said, well, how can we put together a transaction like this? I said, well, get your attorney on the phone and we'll talk through it together. I'm not an attorney. I'm not an advisor. I'm the custodian. So he got his attorney on the phone and we talked through a joint venture structure. So here's what Doug and Ron did. They took down this property. It was a single family home. Purchase and rehab was $75,000. Doug brought in his $13,000 and some change. Ron brought in the remaining amount. They sold the property. And when they sold the property, they negotiated that 50% of the net profit would go back to Doug's Roth. And then the other 50% of the profit would go back to Ron. When it was all said and done, and this was about 4 weeks ago, the property sold, the wire transfer came back into the equity trust Roth IRA, $47,000 and some change. He made $34,000 tax-free on that one transaction. So even though he only had $13,000 and some change in it, he was able to negotiate with his investor friend, Ron, in order to get a larger percentage of the profits. So real estate joint ventures, the reason why I bring that up is they can be very impactful for those that maybe only have a smaller amount of money in their IRA.
I did not know that. That's a very interesting nuance to be aware of. Very good to know. Huh. Okay. And back to the UBIT, which the unrelated business income tax that you hit on briefly before, say that we're using an IRA because we don't have that solo 401k that's exempt from it, and I'm investing, I'm looking at a syndication where you got the sponsors, the GP, general partner, and then you got the passive investors that are the LPs. So both would be having to pay the UBIT if they both used IRA funds, right? It's not like it only applies to passive investors or only applies to the sponsor. Is that correct?
Yeah, anyone involved in a LLC, limited partnership structure that's being taxed as a flow through LLC or LP, which most are going to be, of course. I think it'd be pretty rare to see an LLC tax as a corporation or a corporation that owns passive income rental property, multifamily storage facilities, whatever it may be. So if whether you're a GP, LP, both, doesn't make a difference. If an IRA is involved in a LLC or LP that owns commercial real estate or residential real estate or any type of real estate, doesn't make a difference, and there's debt on that property, you're going to have exposure to unrelated debt financed income tax. Now, there are write-offs. Obviously, with commercial real estate, you might do a cost segregation. There might be a lot of bonus depreciation that passes through to the LPs. The same is going to apply for an IRA investor. So to offset that UBTI, unrelated business taxable income, or unrelated debt financed income, to offset that income, you have depreciation deductions, you have your operating expense deductions that also pass through on the K1. So for an IRA investor, they may not have any exposure. They may even show losses that they can carry forward. But at some point or another in the future, there's going to be an exit, the property's going to sell, right? And at that point, while there's still debt on that property, the IRA is going to have some exposure. Now, what I tell folks is don't be fearful of unrelated business income tax or unrelated debt financed income tax. There are plenty of investors out there that the economics still work for them. You just got to pencil it out. You need to crunch the numbers and determine if it makes sense for you or not. The big question is are you gonna make a better return investing in those types of opportunities, even after paying the taxes, compared to investing in a stock market based portfolio? If you conclude as an investor, I can't conclude that for you, but if you conclude as an investor that you can make a better return and you feel more confident in hard assets, real estate, in a syndication compared to the stock market, you're probably on the right path. Again, I can't tell you that, but I can tell you that a lot of investors ultimately make that conclusion because that's what they're passionate about, and that's ultimately what they want to do. So unrelated business income tax is something to address, not something to be fearful of. And for those of you that are trying to wrap your head around this, like, what does this mean? It's like a complete foreign language. We have a YouTube video. We have a great YouTube video. Go to Equity Trust on YouTube. Just search UBIT. I do a 10-minute explainer for you. And I'll give you a quick 2-minute here. What unrelated debt financed income tax is in an IRA context is this. Let's say we bought a property for $100,000. Let's remove the syndication structure for now. Let's say we bought a single family home for $100,000 and we borrowed $50,000 in what's called a non-recourse loan, meaning we don't sign a personal guarantee. So we're at 50% leverage. $100,000, $50,000 down payment from our IRA. We get a loan for $50,000. We're at about 50% leverage. What's going to happen is 50% of our net profit. So we take all of our rental income, we subtract our operating expenses, we subtract our depreciation, and then we get a net figure. 50% of that net amount, we're going to have to pay unrelated debt financed income tax on, because 50% of the property is leveraged. Now, as we pay down the mortgage, let's say we get to a point where only 20% of the property is leveraged. Okay, only 20% of our net profit is subject to unrelated debt financed income tax. And once we wipe out the mortgage completely, we pay off the debt, and then we wait 12 months and a day and we sell the property, no unrelated debt financed income tax. So that just helps people understand a little bit more in a broad stroke how unrelated debt financed income tax works. There's other nuances and circumstances that can come up. So I highly encourage folks to talk to their CPA or their tax professional with respect to these matters. But certainly there's some resources out there for you to take advantage of. I referenced the YouTube video, which is a great way just to kind of comprehend and wrap your head around what this means and how it works.
Yeah, it's definitely helpful, and I'll drop it in the show notes as well if people want to click over to that after listening to this. So I had one more question on there that slipped my mind. Oh yeah, what is usually like the tax rate? Is it like tax as ordinary income, or what percentage of tax did you pay?
It could be long-term capital gains tax rate, but generally speaking, it follows the estate and trust tax schedule. So the estate and trust tax schedule, get ready for it. It's a very aggressive tax schedule. So it's graduated. It's like the ordinary income tax schedule where there's tiers, but it's more aggressive. So for example, once you get to $13,450, you pay a 37% tax. So very, very quickly you get to that top tax bracket. It's sometimes I refer to it as a punitive tax. And again, it's sometimes though, when you have an IRA that doesn't have a large balance, that's just what you need to do. I have a client that he's done several transactions with his children's Roth IRAs where he takes on almost 100% of these deals he takes on with debt. And he'll put $3,000-$4,000 in a deal with a Roth IRA and get a loan, what's called a non-recourse loan again, or he's not signing a personal guarantee. And he'll flip a house and he'll make his profit. He'll pay his 37% tax and almost 100% of the profit. But he's getting profit back into that Roth IRA, and then that amount is growing tax-free for the rest of his children's lives. And he's had Roth IRAs for his children since they were 5, 6, 7 years old.
I never thought of that, but that's really interesting. I have a son right now. He's only about a year and a half, 15 months old. So I'll look into that too. It's a good idea. But,
Is he around? Just pop him up on the screen and, pay him. Right?
Yeah, exactly. He's at daycare right now. Otherwise, it would pop him up on the screen. But it's actually hard to get work done even if you're working from home, or I'm in my office now. So my commercial real estate actual office, not home office. But anyway, yeah. But yeah, it's hard to work from either place if you have a baby crying in the background. That's the point. But yeah, that's a very interesting thing. So that sounds like just yesterday I was talking to my estate planning attorney to set up a living trust, which is a revocable one as long as we're alive, me and my spouse. But once we pass, it becomes irrevocable. And he was talking about it being taxed at 37%. I know we're starting to go off on a tangent, but it sounds like that's maybe the exact same tax schedule.
Correct.
Yeah.
Yeah. Yep. Yeah. So, IRAs are trusts. It's a grantor beneficiary trust. So you can think of the IRA as a trust in the similar context of any other trust, but it's an IRA trust, and there's certain tax privileges associated with the IRA trust.
Huh. Okay. Very cool. Last question on that before we move on. What kind of lenders, I mean, it probably depends on your own credit profile and all that, but what kind of lenders usually allow you to not sign a personal guarantee?
They're usually you'll hear that term used, non-recourse lender. And who does these? I know two banks that do them for the most part across the country, national lenders. The first one is North American Savings Bank, and they're out of Kansas City, Missouri. IRAlending.com is their website, I believe. And then there's another bank called First Western Federal Savings, and they're out of Rapid City, South Dakota. And they do non-recourse loans to IRAs, meaning that the IRA account owner isn't signing a personal guarantee. And I've also worked with a lot of customers that have relationships with smaller local regional banks that are portfolio lenders. You really got to find your portfolio lender, your sort of traditional regional bank, kind of savings and loan type feel organization. Those are the types of banks that might be willing to underwrite a loan for you and not demand a personal guarantee. But you go into your big shops, they're not going to do it because there's really no secondary market for non-recourse paper. You don't have, the Wall Street buying machines looking for non-recourse loans where people don't sign personal guarantees. That stuff probably makes them cringe on a spreadsheet. So not interested in buying that type of paper. So you got to find some specialty lenders out there and look in more of the nooks and crannies of the lending space. They're out there though.
Yeah, that's definitely helpful and encouraging, because I think even for myself at first thought, I'm like, I'm never going to find a bank that allows me to do that. It's crazy because every one of them, they always ask me to sign stuff, personal guarantees and second liens on my rental properties and all crazy stuff, but good to know. So changing gears here, we can wrap it up here pretty soon. This last few questions. I had my tax advisor tell me that you could also use an HSA. You actually hit on it previously a little bit. You can use an HSA essentially as a vehicle to invest in things similar to an IRA. So what do you think about using HSAs? Obviously, once you actually use the funds, you can only use it on medical expenses, but the argument kind of made sense. Like when you're older in your retirement years, you will have more medical expenses. So what do you think about that?
We do have clients that self-direct their HSAs. It's nowhere in comparison to IRAs, naturally, because people just have a lot more money in their IRAs than they do HSAs. The average American actually only has about $3,000 in their HSA. And it makes sense why that is, because what do people do? They fund their HSAs, they get their deduction, immediately through usually salary deferral, and then they spend it throughout the year because they have healthcare expenses. That's understandable. It's a high deductible healthcare plan you have, so it takes a while to get to your premium, or I'm sorry, your minimum deductible. So you're using that HSA throughout the year. But some people they don't do that. They put as much money in their HSA every year. They don't use it. They contribute to it and they want to grow it tax free. And the HSA is interesting because your contributions are tax deductible. It grows tax free. And then when you take the money out, you pay 0% tax. And so I've had some customers that have partnered up their HSAs with their IRAs to make private money loans, invest in real estate syndications. In fact, I had a client that he invested in a real estate syndication that had an exit in about 3 years out. So it was a pretty quick, like, buy, add value, and then sell. And he made about $20,000 in profit. He invested $20,000 and he made about $20,000 in profit. And that was all tax-free in his HSA minus the UBIT tax that we talked about before. And so then he was able to take that money and just put it into another investment. And that's all tax-free money that he'll be able to pull out and not pay taxes on it. So as long as he's using it for healthcare related expenses. So HSAs self-directed can be great if you're in, I'll call it squirrel mode. So if your goal is to squirrel away as much tax-free dollars in the HSA and keep it for your longer term retirement needs and longer term medical expense needs, then it makes complete sense. But if you're just essentially using the HSA to pay for your expenses and you're going to use up the same amount that you put in on an annual basis, there's really not much you can do from a self-directed perspective. You really have to be in the mindset of long-term growth for that account.
Okay, but if needed, then you could roll over wherever your HSA is sitting and roll it over to a self-directed IRA custodian, like equity trust.
Absolutely. And you don't have to move at all, Mason. So, for example, I have an HSA with HSA Bank. And when I do my salary deferral and employee match that goes in there and all that, it goes right into that HSA Bank account. It's just easier to do that. We have a debit card tied to that and all that. And then what we can do is transfer a portion every year of that HSA Bank HSA to our equity trust HSA. You can have more than one HSA. It's just like an IRA. So you just open up an HSA with equity trust, transfer whatever amount you want into that HSA with equity trust, then just use your HSA with equity trust for your self-directed investments and keep your HSA where it's at now for, any healthcare related expenses that come up. And the last thing I should mention, Mason, this is to me one of the most powerful provisions of the HSA legislation and the HSA law. Section 22.3, I believe, is what it is. And there's what's called a HSA healthcare reimbursement provision. So here's what it is. Let's say I incur an expense today. Let's say it's a $5,000 medical bill that I incur today, and I pay it personally out of my own pocket. And then let's say my HSA doesn't have $5,000 yet, but I go out and I do some real estate options. I do some other investments. And let's say I grow that HSA to $10,000. I can then take the $5,000 out and reimburse myself. It's called a reimbursement provision. A lot of people aren't aware of it. So what it does is it allows someone to actually get a little bit more runway in their HSA so they can grow that a little bit longer, and then they can just reimburse themselves tax-free at a later date.
Yeah, I had no idea. That's interesting. So just again, changing gears a little bit, what are some other things besides like real estate, private equity, or hedge funds that you could invest in with a self-directed IRA?
So you got it. Private equity, hedge funds, venture capital, physical gold and silver, you can invest in with your self-directed IRA, cryptocurrency. There's only a few types of investments that you can't do. We talked about prohibited transactions, disqualified persons. And then you can't use your IRA to invest in collectibles like artwork, for example. Can't do that. Alcoholic beverages, life insurance policies, and your IRA can't be a member of an S corporation. Your IRA can be a member of an LLC, a C corp, limited partnership, but you can't have a membership interest in an S corp with your IRA. You can make a loan to an S corp, but you can't have a membership interest in an S corp. So there are certain things that are considered disqualified or prohibited. Good news is that list is very short. There's a lot more that you can do with your IRA than you can't do. The IRS and the government, when they created the laws, was exclusive rather than being inclusive.
Okay. Yeah, and I forgot to mention for anyone who's wondering what HSA is, it's health savings account. People probably picked up on that when we talked about medical expenses, but just want to make sure people were aware in case we left anyone in the dust confused about the last thing we're talking about. But that's very helpful. I think that I have run out of most of my questions here, which is great. I think this is overall very encompassing. The only last thing I could think about, you mentioned it being having membership interest in S corp is not allowed, but LLC is. So it's actually the way that mine is structured now. Is the checkbook IRA, even though mine's a checkbook solo 401k. So can you explain that a little bit? I know it's probably a little complicated for someone that's just looking to invest passively, but that might be helpful for people to be aware about that process.
Yeah, so there's what's known as a checkbook solo 401k or checkbook IRA. Certainly can be done. You do have a few steps extra involved in additional expenses because you have to form an LLC and your IRA becomes the sole member of the LLC, and then you're the manager and you form a bank account. And one can do that, but they can also use the custodial services. For example, here at Equity Trust, we've built in an integrated technology platform a virtual wallet for our customers. So in most instances, an LLC IRA is not necessary. They can pay for expenses, utilities, contractor payments, so on and so forth, renters, funds flowing back into their IRA. So we've actually built a system that disintermediates the need for that LLC IRA. That also puts our clients in a position where they don't have to take on the risk of potentially engaging in a prohibited transaction, because LLC IRAs can present additional risk to the individual investor. In fact, there was a case called the McNulty case in November of 2021 that addresses the checkbook LLC IRA and doesn't deem it a prohibited transaction to have one. But the IRS court did go on to refer to unfettered control as a great concern in their eyes. And so they kept mentioning that concept of having unfettered control of the IRA account. The design of IRAs in the law was to have a custodian, and an LLC IRA can sort of disintermediate that. Solo 401ks, though, those operate under a little bit different jurisdiction, so to speak. You're the trustee of the solo 401k, so the rules around solos are a little bit different than IRAs.
Okay, that's helpful. Yeah, like I mentioned before the recording, I just closed my first transaction using this, and it was actually very easy. It was just like using my normal business bank accounts. I just told my bank where to wire the funds, and now the title company will wire the funds back into that account. Pretty easy, just swipe my hands. But
yep,
yeah,
you got it.
Cool. All right. Well, I think that we covered most everything here, except on that. So since for the checkbook IRA or solo 401k, since I created the LLC, I actually need to ask my custodian, but you might know too. Do I need to file like a separate tax return for that LLC I created?
It's most likely a single member LLC disregarded entity. So, you know, more a question for your CPA than your custodian, but most likely you don't need to do anything.
Okay, that makes sense. Yeah, I'm the only member and all that. So yeah, makes sense. All right, great. Is there anything else you want to hit on before we wrap it up?
No, not at all. I appreciate the time, Mason, and the opportunity to share a little bit about Equity Trust for those that are interested in learning more. Easy to find us. Just search Equity Trust Company. You can look online on YouTube and find all of our video materials and content. Our website is trustetc.com. And if you have questions, you can reach out to us. We have associates. We refer to them as IRA counselors that can answer your questions and help you through the process.
Okay, perfect. And do you want to leave like a direct contact information for yourself, or just let them go to the website? How's it work?
Yeah, website's the best place. Phone number, 888-382-4727. That's the best phone number to reach our IRA counselor team. Again, that's 888-382-4727. Or again, just find us online, trustetc.com, or Google search Equity Trust Company. Again, we're really easy to find. We do weekly webinars. We have lots of YouTube training. So if you want to learn more and really dive into this, there's plenty of content that we have available for you to learn more about it.
All right, perfect. Well, thanks a lot for your time, John. I think this was very helpful.
Oh, thank you, Mason. Appreciate it. Anytime.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablere.com. Thanks a lot.